Hello, everybody. It's great to be here to talk about an issue that at Ribbit Capital we think about all the time, which is digital assets still an investable asset class? We think yes, but we'll see what this panel tells us. I'm going to start with Commissioner Pham. Commissioner, you're on the CFTC. You travel all over the world. You've really been a thought leader in thinking about how regulation, how this space should be regulated. And yet, all over the world, I get the same question. What is going on with the United States? Lots of governments are making a lot of movements, but yet everyone is waiting to see what the US is doing. So I'm going to ask you, what is going on with regulation of digital assets in the US? And feel free to make it spicy.
Well, thanks so much, Sigal. It's wonderful to be here today. Thank you so much to the organizers and to the MAS. I have to give my standard disclaimer, which is that the views I share today are just those of my own in my official capacity as a commissioner and do not necessarily represent that of the CFTC or of any other commissioner. So I think one of the things that I've really appreciated about my role is that I've been able to take my private sector experience working for 8 years at Citigroup, particularly in the digital asset space, being at the CFTC even before that, analyzing Bitcoin and the regulatory status of it, and talking to everybody about what are the opportunities in digital assets and what are we really talking about here. And I think we are at this very unique inflection point for tokenized assets because there are real live use cases that are out there. We are modernizing infrastructure for the financial system, and this is enabling access to markets, greater access to markets at less cost, more efficiency, more resiliency. So what I see in the United States is really 3 blockers. First is preparedness. There is, amongst the policy community, I think, still a need for greater awareness and greater understanding about what tokenization is, what are the benefits of it, and what's the difference between tokenizing a financial product or tokenizing financial services versus speculative junk tokens. There's a big difference. In the United States, we really need to focus on separating the good from the bad. There are bad people who use technology to do bad things, but it doesn't mean that the technology itself is bad. So there's preparedness. That's something that needs to be worked on. I've tried to advance education and outreach through my work with the CFTC's Global Markets Advisory Committee, where we've had a number of panels on tokenization and the real use cases. The second blocker that I see is around perspective. I think that people don't understand really, again, the full benefits and potential of this technology. If people understood that in many cases, tokenized assets, or the tokenization of assets and the tokenization in financial markets and the financial system is really about upgrading pipes and plumbing, it's very boring. It's actually a very boring story, but a great story, a huge story that could unlock 19 trillion in capital and collateral that could bring 20 billion in operational expenditure savings right away. So these are things that I think people need to understand better. They need to have some perspective. If because there were scams and fraud with online shopping back in the 90s or the early 2000s, and we decided that's it, no more online shopping, no eBay, no Amazon, no Google, can you imagine where we would be today? I think we need to understand that as we move towards Web3, as we move towards virtual worlds or the metaverse, there's going to need to be a transaction layer. And it seems that DLT could be a solution for creating that transaction layer, whether it's financial transactions or just the transferring of some type of digital token, which represents potentially a tangible or intangible asset or a digital right to own something or to use something or to transfer something. So this type of perspective, taking the long view, is something I think that's very important that we need to see more of in the United States. And we see other jurisdictions doing that better. Here in Singapore, they've clearly taken a long view. They started with Project Ubin back in 2016 in exploring the potentials of using DLT to modernize the financial system. We see in South Korea a lot of advancements being made in looking at DLT there. And a lot of other things where there's commercial use cases for DLT and for blockchain for example, in making supply chains more diversified, more resilient, and in tracking provenance and having credibility and authenticity. The other blocker that I see is really around planning. Again, as economies around the world move to a focus on the digital economy and services to drive greater economic growth and economic security, the United States can't be complacent and just take it for granted where we are with our position. There are other jurisdictions, other countries that are looking to drive growth who would be happy to take even just basis points of that GDP. It's a big difference for them. It's something where I think we, the United States, cannot be too complacent about that. So we need to have planning, we need to have forward vision, we need to have a unified industrial policy. All of this is going to enable greater growth, greater access to markets.
That is a great lead-in, Jason. You are at Fireblocks. A lot of what Commissioner Pham was talking about was about preparedness and resilience. Tell us a little bit first about how that plays into the Fireblocks model. Your customers range from some of the biggest financial institutions in the world to e-commerce solutions, to NFTs, to decentralized finance, and in many respects, what you do is provide a lot of resilience. So tell us a little bit about that, and then I'm going to ask you, for Fireblocks, whose mission is digital safety, soundness, and digital assets, what needs to happen for Fireblocks to achieve its business mission over the next 10 years?
So thank you, Skal. I think there are probably two parts to that question. And I'll first talk a little bit about Fireblocks, and then I'll actually try to tie it back into tokenization, because I think this is a really interesting point as well. So Fireblocks is a wallet company, first and foremost, right? The wallet is the place where the digital asset resides. It's the point from and to which value flows. And securing the wallet, in our view, is absolutely fundamental. It's table stakes for us, but for the industry and the industry we want to see created and grow, right? It's absolutely something that we have to ensure if we're going to have the digital asset-based ecosystem we want to see. And just to give a sense, right? We were talking about tokenization. So what's interesting to me about tokenization today is not so much the minting part, right? So I think we understand, especially those of us with financial services backgrounds, what the benefits are in terms of efficiency, in terms of updating the rails, in terms of unlocking assets that are dormant or hard to move, like real estate. So people get it, and yet tokenization in a large part has not taken off. And I think what's interesting is to think about, why is that the case? And I would argue that the reason that's the case is because you need to build an entire downstream ecosystem that's ready to accept the asset that's been tokenized, right? So it's not the sell side, it's not the asset generation side that's been lagging. We see a lot of interest in that at Fireblocks, but what we have to do is get the secure wallets into the hands of a downstream buyer, and then get an active secondary market, right? And all of this requires infrastructure, and this is exactly the type of infrastructure we're building at Fireblocks, just to give you the use case, right? The second piece, Sigal, I think you asked me, what is it going to take for Fireblocks to be successful or execute on our vision? Our vision is really to enable businesses, to the extent they want to be enabled, to participate in the digital asset economy. And I think that goes to really the kind of like broad set of customers that we already have to date. The platform is agnostic as to what you want to build, but come to Fireblocks and build on it. And I think there are a number of things that have to happen. One of them would be really great participation from the United States, sensible regulation, clear rules of the road. What we're seeing right now globally is something slightly different, which, while not ideal, I think is also a major opportunity, right? So the world has changed since, let's say, 2008, 2009, when we had a huge multilateral project to introduce regulation to curb the excesses, right, of the financial crisis of that time. We don't have that kind of consensus mechanism. I mean, we have them, but things have shifted, right? And what we have instead now are regional powers, and we have coalitions of like-minded nations coming together and then splitting apart, right? And what this means for regulation, this is reflected in regulation. So we have the United States, which is lagging behind right now, and then we have other places like Singapore, which are forging ahead and in fact being quite innovative, and they're not waiting for any sort of mandate from on high to go and do that. And there are a handful of jurisdictions that we see around the world where there's this kind of innovative, forward-looking thinking around how are we going to capture a slice of the digital economy, which is coming. And so we're very active in all these places and doing what we can to provide insight and perspective, and we do view this as critical to achieving our mission.
Thank you. Eric, turning to you. You have you've been in the investing space, we won't reveal your age, but for quite some time, let's just say. And today you're at one of the most important companies in the space. You're at Coinbase. You're also founder of One River Asset Management. And you still straddle both of TradFi and crypto. We were talking before about how, despite what you hear in the news, this is actually, digital assets have actually remained quite resilient. Tell me why you believe that's the case, and what keeps you could easily just go back to the other side fully. What keeps you interested and excited about the future here?
Sure, and thanks for having me, Sigal. So I actually entered this space in 2020. So we made what at the time was the largest institutional allocation to crypto, which is Bitcoin and Ethereum, in late 2020, and ironically got out over the course of 2021. The bull market was just was quite extreme, but through that period, as I looked at the technology, because the intent of making that investment was to help mitigate some of the inflationary risks that we saw forming in the U.S. economy, and we thought Bitcoin and Ethereum presented a really highly convex expression of an inflation theme, and it just worked out so well so quickly that we moved on. But through it, I looked at the technology, and what seemed evident to me was that this technology would lead to the tokenization of all assets at some point, just because the efficiencies in terms of trading speeds, settlement, transparency in terms of reporting. I actually, ironically, thought from a regulatory perspective that these technologies would ultimately provide regulators with much more insight into the holdings of assets across the economy, and therefore, while at the time it didn't seem obvious, these technologies, if deployed properly across the financial markets, would lead to greater financial stability, just because regulators could wrap their arms around things, and we wouldn't have bad actors that could run away with leverage without being seen, for instance. So that was what really got me interested to actually start a digital asset trading company, as opposed to just simply making a trade. It's what keeps me interested. I do find it fascinating just how resilient these assets have been. So, and it was something that I identified, relatively early as I had looked at Bitcoin. As many people would look at would look at that bull market and a subsequent bear and say, well, this is just another, tulip mania type thing. Having been someone who studied financial manias over the course of my career, what you see in historical manias is you do see a parabolic rally, and then you see a collapse, and then you see more or less a flat line. And Bitcoin had been through numerous cycles like this, and it seemed to bounce back. And so it doesn't mean that it's not subject to the same forces that manias are, but it seems rather different. And so I think, as I reflect back on what we've seen from that 2020 period to 21 to the bear market of 22, and I'd say the climax of that bear market was the FTX implosion and the panic liquidation. These asset prices are up, certainly in some cases well over 100%, in many cases 100% or more, in an environment where I think people are still pretty pessimistic. Someone before this panel said you have to mention crypto because no one at this whole conference has mentioned crypto. So I'm hoping that the commissioner mentions that just for sport. But from my perspective, these assets, even though they're unloved right now, have done extremely well. And I think if you had thrown, if you'd thrown this level of Fed rate hike, an SEC lawsuit against Coinbase, which is essentially a lawsuit against the whole industry, and some of the financial frauds at any other asset class, I think we would have seen, a catastrophic decline and a flat line. And instead, that's just really not what we've seen at all. So it tells me there's something to it. I suspect that it's some kind of nexus between these assets and this move toward tokenization. I think tokenization is going to drive the next big bull market, even in things like Bitcoin and Ethereum. I think they'll ride that wave. But anyway, that's what I see.
Thank you. Xiao, turning to you. So, as Eric just mentioned, we have seen fraud, we have seen scams, we have seen some very risky behavior over the last year and a half, let's say. And you're an investor in this space. Did any of that scare you off?
Well, the short answer will be no, apparently. So we are a real believer in this whole crypto industry. So there are like two sides of this topic. So first of all, I do think those scams or those frauds have really great negative impact on crypto adoption, especially for some non-crypto users. Maybe the way for them to get to know about crypto is reading the media report about a fraud or about a scam. So that really scares people away. But on the other hand, we can see that in the past, after all this fraud, especially those bigger ones, they will really accelerate or maybe trigger the regulation. So as a investor or maybe as a contributor of the whole industry, we also need to stay graceful for all this fiasco or for all this fraud, because we can the industry also benefit from the regulation as well. And at the same time, we also learn lessons from all these fiascos. For example, some bank run, FTX bank run. So after all this users loss, they will learn the lesson that maybe the biggest risk in the crypto industry would be counterparty risk. It's not even the price risk. So you need to know who are you dealing with, and who is your counterparty, and how will they conduct their business. So as investor, what we learn is that when we do due diligence on a project or on a deal, we may use more tools to analyze their credit risk or the counterparty risk. For maybe some tools like Chainalysis or some smaller ones, we will do the address analysis and see how they manage their asset and how they manage their client's asset. So, all in all, I think the negative impact will be in short term. So maybe it's just the mass adoption will be a problem of 3 years or 5 years. The delay is not very, it's bearable. When you look at longer term, for example, when you look at life term, it's 2 years delay will be totally bearable, yeah.
Caroline, Malcolm, you are Chief Policy Officer at Chainalysis. At Chainalysis, you help do some of that diligence. You help the public sector, the private sector understand what's happening in terms of illicit activity. And in fact, just like I did when I was Undersecretary of Treasury, you wake up every day thinking about North Korea, Hamas, how can we prevent bad actors from entering into this ecosystem? You also came from more of a regulatory background. You were at the OECD. I'm curious, when you think about the jump that you made into crypto, and you surround yourself every day with news of illicit activity, but you also interact with policymakers all over the world. Do you get scared? Do you sleep at night, or do you continue to get excited about the future this new chosen profession of yours.
Thanks, Sigal. It's really a pleasure to be here, and this is such an interesting conversation. I'm pleased to report I do still sleep at night. And the reason for that, and I think it's very fascinating, coming from a much more sort of traditional background, spent my whole career in government before coming to Chainalysis, I always found it very fascinating, the sort of negative focus that was placed on digital assets, because when you really look at the data, that's not what's borne out, and yet it gets so much of the attention. And it's always a tricky conversation to have, because certainly, like, you know, $1 to terrorism financing is $1 too many. You know, money lost to people in scams is something we should be looking to eradicate. And at the same time, the data is very clear. Governments have been very clear. We just had some recent statements from Wally Adeyemo at US Treasury re-emphasizing this point in the context of the current conflict, that there's still more concern about what's happening in the fiat world than what is happening in the crypto world when it comes to illicit activity, whether that be, you know, scams through to terrorism financing. And so, you know, something that Commissioner Pham mentioned was this importance of education. And that's a lot of work that we do in the policy team at Chainalysis. Obviously, you'll have seen all the public information that we provide, but we do a lot of work with governments, helping them to think about, you know, what the data really tells them, rather than just what's being seen in the headlines in this space. And I think what's kind of interesting, and it comes back to something that Eric said, is there is enormous amount of transparency that is possible in this space, and yet we are still seeing regulators kind of making that mind shift from, you know, a world in which they receive reported data. And there's always in the traditional finance world sort of this holy grail of embedded supervision, which is something we've been talking about for quite a long time. And yet in this space, this idea of real-time supervision is something that can very much happen already. But getting people to realize that, to feel confident in that, to trust in those systems is something I think we're still very much kind of on the journey of doing, because it is possible to get that kind of whole picture of what's going on in the ecosystem through using the transparency of the underlying technology. And that's very much helping people understand really that shift and what's possible here, and understanding the ways in which this sector is different and ways in which it is similar to other areas that they might supervise is kind of very much kind of my day-to-day work.
Thank you. And so back to Commissioner Pham. Caroline just talked about real-time supervision. Eric said that when he saw this technology, he thought this is going to be terrific for regulators because they can really wrap their arms around it. And yet, we know that in certain jurisdictions, possibly the United States, it's actually been quite difficult for them to wrap their arms around it. Why is that the case? And what needs to happen to change that? You talked about the blockades, but why aren't people getting what we see every single day? What's holding them back?
It's a great question, and I think there's a couple pieces to it. So going back to one of the first things that I said, it is this distinction between tokenization of financial products and financial services, which regulators all around the world have spoken with one unified voice. It's same activity, same risk, same regulation. And so to me, I don't think it's that difficult to solve for tokenizing financial services. It's already happening. There's billions of dollars a day already across business lines and product lines that are moving on tokenized rails more efficiently, cheaper, safer. So for all of those people out there who are like, oh, is this a real thing? Tokenization is real. It's real and it's live and it's active now. That distinguishes it from speculative crypto assets. There I said the word crypto assets. And how do we regulate and solve for crypto assets? And crypto assets could be anything, right? It's a digital representation of an asset, which could be anything. It can be money, it can be some other financial asset, or it can be something else altogether. And so in drawing that line, I think the short answer in the United States is that people are trying to do too much all at once, all together in one thing. It took 100 years for us to get our securities laws and regulation to where it is. It could take another 100 years to change it. I think a much more practical way to approach this question of what is a security and what is some other kind of digital right or asset or other anything is to separate out the equity or debt function, the investment contract characteristics of a token from the actual asset part of it, whether it's a utility token or it's a tokenized representation of some physical asset or anything else. So that's what I think would be maybe not exactly low-hanging fruit, but certainly a much easier task than this Sisyphean uphill battle of trying to change the U.S. securities laws and regulations.
Eric, what do you think about that? Do you think that that's the way of the future for us for there to be this understanding of what that separation looks like? And
yeah, so I'm not a regulatory person. I knew enough when we got into this space to reach out to people who knew what they were talking about, like the commissioner. Jay Clayton, the former SEC chair, was that person. So I reached out to him the day after he left the SEC and said, I'm entering this space. I clearly need a lot of help. I think it will be a very important technology, but I know that intersects with policy in important ways. And so, I speak with him very regularly. One of the themes that in fact, just this week he was talking about was, I think, really the same point, which is that his view is that the industry has pushed far too hard, Coinbase being an example, to have some overarching regulatory big bang, really, and what's more and it hasn't really worked. And what's more sensible is just to try to carve out some of these finer points and create small wins. And I don't mean adversarial wins. This isn't business against government. It's just surely there are certain things that we can agree on about customer protections, about anti-money laundering, about fraud, about these various things. And so as opposed to trying to solve them all at once, let's just start banging them out, piece by piece. It seems very obvious, to me anyway, that there will be such things as security tokens. There'll be things that are, a tokenized equity ownership in a company is surely a security. It's just in a tokenized form. And a piece of art is something different, and a tokenized representation of a chunk of gold or copper is something different. So I'm all for that. I'm not really engaged in that debate, but I think that, and I suspect that that's where we'll get to. People exhaust themselves over trying to solve this in a comprehensive way all at once, and we'll just start banging away at things that are pretty obvious for us to agree on. And then as we get to those things that seem a little bit more nuanced, we'll at least have some type of framework upon which to build and answer some of those questions. So I think that, by the way, I think that that's coming over. I know we're all kind of exhausted at this stage, but it's usually after you get exhausted that you start making some real progress, because people, and it's not that they let their guards down, that they just seem a bit more amenable to just coming to compromise. So I think we're getting there.
Well, and that's the difference, right? That's the difference with the United States and other jurisdictions, because other jurisdictions have, in an incredibly pragmatic way, tackled each of these areas and addressed just the specific pain points in those areas. So I think that's where you see the difference, where you have serious progress being made around the world around tokenized securities markets, and yet the United States, with the deepest and most liquid capital markets in the world, isn't in the same place.
Jason, your customers, again, include just like this tremendous range from e-commerce, Shopify, NFTs, collectibles, banks, Bank of New York, Mellon. Tell us a little bit about why Shopify? Why are these commerce platforms getting into this space? How much energy are they putting into it? Again, 5 years from now, how should we think about the intersection of commerce, digital assets? Will people be using the word digital assets, or will it just be a new way of operating online?
Yeah, Sigal, thank you for the question. I think it actually gets to a really interesting point, right? So Fireblocks in our customer base and its growing diversity, right? It's just emblematic, and in fact, what it's emblematic of is the ultimate diversity of use cases that I think we'll see develop over time. So the conversation, rightly so, tends to focus on crypto assets. In the public imagination, right, it's all about the price of Dogecoin and Bitcoin, right, and what we refer to now as a crypto casino, right, and pejoratively. So I think this has done the industry a kind of disservice, and in a way, right now in this crypto winter, there's a great opportunity to emerge with something that looks really different. And what I mean by that is that the real innovation here, the innovation underpinning the tokenization of securities, underpinning Bitcoin, underpinning all of this stuff, it's the distributed ledger, right? Period. It's distributed ledger technology, decentralized, updated by its users, et cetera, et cetera. And what's really interesting about this actually is that when we're really successful, we will have distributed ledger technology underpinning all of the processes that we go through in our daily lives, whether it's payments, all things, right? Like operations, all these things will hopefully migrate to a distributed ledger. To think about it compared to AI, right? AI is the hot topic these days. I think if you think about AI and you extrapolate into the future and how is it we're going to interact with these things, they're going to become embedded in our lives, right? They're going to become embedded in our phones. They're going to replace Siri. They're going to replace Google or augment them. So it's going to be something that we're familiar with, but it's not going to be this thing that stands out in the way that a jump in a digital asset does to us today. So to bring it back to your question, Sigal, right? It's like, what is Shopify doing here? What are our other customers doing here? We have financial institutions, traders, et cetera. They're all doing some version of the same thing, which is they're trying to find ways to integrate distributed ledger technology into their business operations so that they can participate in this new, more efficient economy.
We actually have a question, Jason, for you, but I'm going to throw it out to the two of you. You mentioned asset tokenization sell side maturity, but not yet buy side. What do you think is needed to grow that demand? And it could be for anybody, really, but.
I mean, for me, I'm not as much of an expert as you, but for me, the tokenization piece that needs to be solved is the buy side. And we're Fireblocks, we develop infrastructure. So for me, there is an infrastructure problem here, right? There's first the product, you have the asset, you mint it into a token, that's great. Then this token will have properties, right? Maybe it's a fixed income product, a yield product, maybe it's a security. These are all great, but you should have a target customer, right, for this. And the question right now is, does the target customer also have the infrastructure, the wallet infrastructure, the secure transfer infrastructure to take possession of this asset and to hold it and to manage it in the way that's appropriate to the asset and its flows, its yield flows, if any. So for me, it's that piece that's coming. There's a ton of interest from people that have the assets in getting them tokenized and distributed. We need to have the folks who are going to buy them.
Xiao, what do you think? What do we need?
I'm not sure. I'm not sure what you mean by buy side, but if it's asset tokenization, the buy side would be still maybe the traditional enterprises or the one who purchase those services or products in fiat in the traditional world. But in some other cases like payment, I think the buy side could be the demand could come from everywhere, everyone, including those retail users, because you can see that maybe in some emerging market like Africa, everyone is buying the stable coin to avoid hyperinflation. So in this case, well, it's not asset tokenization, but it's still like maybe Biset from crypto. Yeah.
Eric, what's your thought there?
I think it's coming. For starters, yesterday it was great. I went over to the booth for Project Guardian, which is for those of you who don't know, and I'm sure I'll butcher this, but it's the regulatory sandbox for tokenization projects, and it's probably many more things than that as well. But there was a presentation yesterday where there were 8 specific projects that were profiled. Tokenizing repo, tokenizing cross-border payments, tokenizing structured notes, tokenizing asset management products. Each one of them was led by very large incumbent financial institutions, JP Morgan, Apollo, HSBC, et cetera. And I think what you're seeing is the traditional financial players experimenting with these technologies. Once you do that, it's literally impossible to not conclude that they're more efficient, more secure, faster, cheaper, et cetera. I think what we're lacking right now is just critical mass. So someone told me, it was actually a skeptic on crypto, maybe 6 months or so ago. It's one of the largest publicly traded hedge funds in the world. It's the CEO. He's an older guy, and we were just debating this topic. Not really debating. He was just yelling at me. But he was just skeptical. He's like, look, people have come in here for the last 20 years. Everyone has a new innovation. Why is this one real? He's like, and I'll admit, I kind of think it probably is, but explain why. And so I did, and he said, here's the issue. The issue is it's like we're all standing on one side of the river, and you're looking across the river, and you can see what it looks like on the other side of the river, and it's way more beautiful than this side of the river, but we all have to get across the river. And if just a couple people go across the river, it doesn't matter. And so I think it literally is that simple. But I'm encouraged because with something like Project Guardian and all those different projects that were profiled yesterday. Incidentally, we at Coinbase are working on one that I think will beat all of those if anyone's interested. And I think it actually will be an outside firm. I don't think it will be one of the big incumbents that ultimately tackles this. But I think it's coming, and I think it's it's almost just in the ether now that when you have enough firms that see the benefits, a pathway will emerge, and probably just like regulation, it won't be with every asset all at the same time. It'll be, a use case, and people go, for trade finance, this works really well, actually. This is fantastic. And we can tokenize trade finance. We can put into ABS securities. We can open up the broader market. It lowers the interest rate, et cetera, et cetera, et cetera. It'll be something like that. But I do think that's coming.
So Caroline, that river includes a bunch of canoes with policymakers, sort of using oars to get across. I did. I was on the other side, and then I got in a canoe, and then I jumped into this space. And that's your world. Your world is talking to policymakers all over the world, and it feels like one of the things that's separating us from one side of the river to the other is to get more acceptance and understanding from policy leaders. And so I actually have a question about how your role plays into that space because it's the meandering of that space that really is going to matter. How are you going to dodge one canoe and get it to the other side? What do you think about that having a policy function in these digital asset companies that are really trying to do something interesting and remarkable that could be the future, but are having sort of problems getting to the other side?
So it's interesting that Project Guardian has come up because at the Insights Forum on Tuesday, it was in the context of Project Guardian that some of the participants in that project had said, the technology side was the easy part. The hard part between these different countries, the regulatory and legal side. And so it's just as much governments who struggle with navigating to the other side of the river as do industry.
But to your question, Sigal, I think when people look at a firm like Chainalysis, we sit in what I think of as a sort of reg tech and supervisory tech space, helping the private sector meet their regulatory obligations, helping supervisors understand the market and continuously monitor it. But when you think about firms which are perhaps the regulated firms themselves, it's often quite rare at the early stages that you have that investment in understanding the regulatory environment that you're launching yourself into. There's a lot of focus on building what you need to build in terms of the product itself, and perhaps less in terms of the context that you're operating in. I hope that it is very, very clear to everybody in this space now that regulation is here, and for the parts of the sector which it hasn't yet touched to a significant extent, like DeFi, it is coming, that writing is clearly on the wall as far as I can see. And it's with that in mind that I think firms at that earlier stage thinking out to, once something is sort of clearly in the future, making sure that you build for that future, like being realistic about the environment that you're going to be operating in, not, perhaps your desired environment, but the realistic about where you're going. The sooner you get ready for that environment, the better off you're going to be. We've seen that time and time again in technology. There is this phase where people are unsure. Is regulation of a particular type coming or not? But once it does become clear that it is, preparing yourself for that future as quickly as possible is really critical. And I think that's where this policy function, particularly, if we think about, from the VC perspective, where you've got firms who don't necessarily have the capability to bring that expertise on board themselves, but they can leverage the expertise in their sort of VCs to do that. I think it's really critical.
Commissioner Pham, I'm gonna give you the last word, which is a question from the audience, which is, do you think that the current U.S. regulatory environment is going to cause U.S.-based blockchain companies to move to places like Singapore, the UK, the UAE, Asia, or will they stay firmly grounded in the U.S.?
So U.S. companies are innovating with tokenization and with DLT, and so let's talk about banks. I think that the shift to using DLT or tokenization to power these transaction layers is not really different from the move to online banking or to mobile banking. How many people were horrified at the thought that people were not going to walk into a brick and mortar branch and do business with a person face to face? And yet it's so normal now to just use an app and to do it that way. You don't even wonder how it happens on the back end, it just happens. I really don't see this as being any different from the move to online banking, to digital banking, for moving securities from paper to book entry to what's next. So from my perspective, it's going to happen. I don't think it's that hard. It will take time. The infrastructure and the ecosystem is important. But again, we have ATMs all over the world. So with these big financial institutions who are leading the way, who are enabling the clients to be able to access that ecosystem and infrastructure, I think that's going to happen.
So stay and expand globally. With that, thank you to our panelists and to our audience for really terrific questions. And yeah, thanks so much.
Thank you.